Yeah, I think one of the things I want to say, you know, our job at the Chamber, or our mission, is to help businesses grow. And one of the key critical areas of that is them being financially and operationally sound, not just more sales. So, you know, from a networking perspective, everybody thinks the Chamber is somewhere where you come to network and you get more sales and everything works itself out. And that couldn't be further from the truth. I mean, our businesses in our community need to be financially and operationally sound. And one of the ways they can be that way, obviously, is to have a good business plan, a good cash flow management tool, a good inventory control tool. And so now's the time for that to happen.
We tell our borrowers that generally the cheapest source of a line of credit for your business is your personal residence. You know, you get some benefits, typically in the form of tax benefits, and it's at a lower rate typically than a lot of business loans can be at. So we tend to refer people, first, use the equity you have in your home if you need a line of credit. We are a permanent financing lender. We do term loans. Now, we can do long-term working capital loans, and there's nothing wrong with that in doing a 5 or 7 year working capital loan, going in understanding that this is permanent working capital, but I understand there is a need for the day-to-day revolving kind of working capital loans. We purposefully stay away from receivables and inventory to allow those to be freed up for your local bank. You know, if we lend in wherever, you've generally got another banking relationship, and we will stay away from receivables and inventory to allow your local bank to do that line of credit. The SBA does have some line of credit programs, working capital lines of credit. There's an express program that the bank uses its own internal documentation and provides lines of credit, and there are no specific collateral requirements on those. I think it's up to $50,000, if I'm not mistaken, but $35,000, that's right, Sherman. So there are some opportunities, but lines of credit are generally relationship built. Wherever your bank is, that's your day-to-day depository bank, that's where your line of credit should be, because the money's flowing in and flowing out.
Anybody else? Tracy?
Yeah, I think it's important to make the distinction between working capital. You have permanent working capital, and then you have short-term working capital. What Dwight was speaking of was long-term permanent working capital, and and it really comes down to how you structure your loan. So we want to make sure that for what you're doing, we structure that appropriately. Permanent working capital might be because you need to hire more employees, or you need to upgrade your computers and software systems, or there's something there that you need, and you need to amortize that over a certain amount of time. Now, we do a lot of lines of credit, and this past year I joked because I was like, when am I ever going to do a term loan? Because all I've done this past year are lines of credit, but they're great for short-term working capital and for producing cash flow. And how we manage that is we tie it directly to what you're doing. So when the money comes in, we get paid back. That line of credit, the principal gets paid down, and then the excess gets wired into your account. It's really a great cash management tool and a way for you to manage your working capital on a specific contract or purchase order or whatever it may be. We look at the length of time that it is, and we really structure it appropriately to that specific deal that you're trying to do. And it's been working wonderful for people.
Good. So there are products and services available to do exactly what he's talking about.
Well, there is some misconception about the TARP monies that are being given to banks. The misconception is that it's just a free gift to banks. Banks have to pay that money back. I hope everybody understands that it is to stabilize the banks, to get them through a tough time due to problem loans and so forth. But we do have to pay that loan back with interest. So ultimately, the taxpayer should not be out any money from those TARP advances. I was just telling Sherman before we got started, we are in a very tough situation as banks. We have one side of the federal government saying, lend, 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 and then we have the FDIC or the OCC or the feds on the other side saying, pull back, pull back, pull back. These are tough times, you need to be very careful. So banks are trying to balance those two things. And but ultimately, in the context of small business, it comes down to, are we doing the right thing for you? Particularly in expansions and startups. Existing businesses, yeah, I think there's a responsibility of banks to work with a borrower that they have had for years and years to get through a tough time. I absolutely think there's a responsibility. But the best thing in the startup arena or expansion arena, the best thing that I can do may be to say, no, now's not the time. Let's look at it in 2010 when the economy's better. But back to existing businesses, yeah, there's some double speak going on. I think banks have a fiduciary responsibility to work with their borrowing base.
Certainly, in speaking with small business lenders at banks and business lenders at banks, there's still money available. There are still opportunities. I think it goes back to some of the premises that we've talked about today, that it's all about relationship, it's all about communication, it's all about plans. It's not about going at the last possible moment and saying, well, I find myself in a really difficult position, I hope you can bail me out.
From a banking standpoint, I tell my folks, history is the best indicator of future performance, but it doesn't guarantee future performance. So we're always going to start with your historical financial statements and then say, we take your 2008 financials and we would like you to come in the door saying, here's what I did in 08. But from a sales and margin standpoint, I'm going to drop this customer, and my sales will go down by $1 million, but my margins will go up by 1% because this was a low margin customer. What this is going to do is I'm going to be able to get rid of the third shift I'm running on the expense side. So we'll be cutting that out. I'm going to stop leasing that warehouse facility over here that was costing me $10,000 a month. All of these things, you've got to break it down into cost of goods sold, to your labor components, to your fixed expense components, and come in the door saying, I know it looks bad, but there's a plan here, and here's what I'm going to do to get through this year. So. Well, RMA standards are size specific, so they're still a fairly decent comparative tool, but there's so much information in the marketplace now, industry data that you can use, that we rely very heavy on the national convenience store industry guidelines and various things. Anywhere and everywhere we can get information, but from a pure owner-occupied small business standpoint, our best source of information is all the 1,500 deals we've done in the past. And if we've done 5 that are similar to yours, we've got a benchmark of information that we can at least compare to, knowing that your business is specific to you and we'll have to make adjustments. But there's no magic book that we can just crack open. There are some books out there that say the typical margins on a dry cleaner are X. But it's very specific, and we look anywhere and everywhere, particularly to our internal performance, to see if your numbers make sense to us or not. I'm going to look at the historical financial statements. If there is a history, that is the basis for our start. If there's not a history and it's projection based, then I'm going to look to your expertise, and I was doing something similar here, and here's what we did here. So it's much more abstract when it's projection based, but if there is a history, that's the best place to start, because unless you've reinvented your company, history is going to repeat itself to some degree. Your sales may be off by 20% because of the economy, but Your margins are going to remain pretty solid, and so that is the best indicator. Now, I tell people in the context of if you're buying a business, there's a principle I call the cash cow principle. Nobody sells a cash cow. You've got historical financial statements that say this business has been producing $100,000 a year after all debts are paid, and they want to sell it to you for $200,000. Why would they do that? Well, it's that principle of there's something I know about the business I'm selling to you that you don't know yet, and you won't find out until 3 or 4 months down the road when you're in the business that, oh, I didn't tell you that you're losing that customer that constitutes 25% of your sales. There's got to be a margin for error there, so we're going to look at the history, and that's why banks want a debt service coverage above 1-to-1. They're planning for that unknown that when you get in there, you'll find out, and we'll find out as your bank.